super excited to have Darius Dale on the podcast. Darius and I, this is our first time meeting, but he's literally one of the smartest guys that I think are on Wall Street. I have followed him through Real Vision. That's how I got to understand what he does and his background. And when I saw him the first time, I'm like, that's a guy, not only that I think is really smart, I just want to talk to him. So I appreciate you joining us on the podcast, and welcome to In the Lion's Den.
Yeah, Terry, it's a real pleasure to be here, my friend. You are far too kind. I say this all the time. I'm a moderately intelligent person. I just work really hard. So for all you young investors out there, it's not about how smart you are, just about how many hours you're willing to put in and your grind and your attitude.
Well, and as far as attitude, I don't know that I've run across anyone that seems to have a better attitude. And so I want to get into that actually, because I learned something about you today that I didn't know. And it sounds like you came from not the typical background, especially for someone that's made it onto Wall Street and to do what you've done. So why don't you give me a minute and explain how that all worked out?
Yeah, totally, man. I appreciate you bringing that up. So I'm born in the States. I was born actually in the Midwest, not too far from you guys, in East St. Louis. So back in the 80s, that was probably the murder capital of the country. It's very, very tough place in the world, place in the country. My folks were very poor. My parents were both drug addicts. So we kind of had a real rough, not kind of, did have a real rough childhood. I was no stranger to being evicted on a pretty consistent basis. Spent a lot of time in and out of food banks. But all that, kind of just really breeds character. I think there's a lot of folks in similar situations like that all across the country and obviously all throughout the world. We tend to have we whine about our problems in America, but it's a lot worse for a lot of people outside of our borders. But, so moved to Seattle when I was, I want to say about 9 or 10. I think I joined sixth grade in Seattle. And, so it's funny because most people like transition to states when their parents move. It's like, oh, we're moving for a job. But, the reality is I want to say we were just moving because I believe the social safety net in the state of Washington on the West Coast was actually better than it was in the Midwest. So it's not that my life got materially better. I just think it became a little bit easier to scavenge and fend for ourselves. But at the end of the day, I mean, how I got on Wall Street is more by happenstance. So I was always a pretty smart kid. But I think I got the biggest blessing in disguise in my life really came in third grade when I was we got evicted from our home at the time, going into that summertime and going into third grade. And the homeless shelter we were staying at, when third grade started, was actually right down the street from a what do they call them, a charter school. This charter school called Del Mar Harvard, which obviously is implied by the name, a very good charter school, a significantly better school than I would have gone to had I we stayed in our original neighborhood. So I spent my third grade year there in that program, and then when I got back to my normal neighborhood and my normal school district, I was about 2 grades ahead of everyone, pretty much for the rest of my life in public school. And so, that allowed me to sort of test well and study well and take all the AP courses and all that good stuff. So ultimately wound up getting an opportunity to play football at Yale. And that sort of opened up the doors to Wall Street for me and never really looked back since.
That's amazing. And what's even more amazing to me is that given the opportunity to go to a school like that, you still had all these other things that could be pulling you the other way. And yet somehow you found a way to grind, to do your work and to focus when that couldn't have been the easiest thing to do.
No, it wasn't, man. It's great you brought that up too, because I owe a lot of my personal success and really just a lot of personal admiration to my older brother. He sort of had a much more traditional life of someone you would have expected to have grown up in that environment, in terms of, kind of getting caught up in gangs and drug dealing and all that stuff. He's turned his life around now. I'm extremely proud of him and the father and head of his household that he's become and the man he's become, because he's a real spiritual leader in our family. But the reality is I'm certainly I'm the anti-statistic, if you will. I mean, the statistic of folks growing up with a lack of resources, with parents who are struggling with drug and alcohol abuse. I myself suffer from physical and emotional abuse, from my stepfather, and there was a lot of things that could have pulled me off of that path. But the reality is, Terry, dude, I hated being there. And it just came down to, it was as simple as that. I knew that, from an early age, from that experience at Del Mar Harvard, that, books and academics were an opportunity to get the hell out of there. Obviously, it was a long investment, a long con, if you will. Certainly being a wolf in sheep's clothing in that regard. But, I knew that I didn't want to be there. And so, I did everything I could at every interval to make sure that I was maintaining, I kept myself on the right path to get out of there, and really to get my family out of there eventually.
Well, I mean, that's pretty remarkable. I guess, I'm just curious now that we've gone down this path, and I won't take too much more time on this, but you're just super fascinating to me. It's got to drive you a little bit nuts when you hear about people that are in that same boat that make all the excuses. You had a difficult road to hoe, and yet you found your way out, right? So when you hear people make excuses, you're living proof that, and maybe you're just super smart, and so maybe you were, but I don't buy that. I think that it's not just about your intelligence, it's about other things too. And I would imagine that's a little frustrating when you hear people making excuses after everything that you've been through.
Yeah, well, so I'm an offensive lineman by heart, by trade. Excuses are horrific. I mean, I don't believe in excuses to begin with. I mean, when you make an excuse as an offensive lineman, it's usually when you're picking your buddy up off the ground,
Mm-hmm.
right? And so, and I think excuses are really just, they're shortcuts, right? They're shortcuts for trying to, for not doing the right thing. They're that's what they are. And so, I don't care what facet of life you are. If you're from someone in my shoes, I don't care if you're a rich kid from Greenwich, Connecticut. Excuse is an excuse. There's no excuse to not succeed when you live in this country, with all the opportunity that we have. Obviously, some folks have more easy access to opportunities than others, but the reality is there really is no excuse to not control, to not put forth your best effort, because right, your outcomes may not all, we're not all going to be able to travel this great distance in terms of going from bottom of the income spectrum, bottom of the wealth distribution to the top. That's a long distance to travel in any one lifetime. But the reality is, the distance that you don't have to travel is your effort. You control your effort, and I think the biggest issue with folks that kind of grow up in a similar situation that I am, and I think the reason a lot of folks don't make that journey, don't complete that journey, is because there's no role models, right? Like, your kids, Terry, have an awesome dad, awesome role model. The kids next door to you, I bet, have an awesome two-parent household, awesome role models. And the reality is, when someone like me gets successful, we don't live in the hood anymore. I'm not living in the hood anymore. Are you kidding me? It's dangerous. It's not a great place to raise a family. And so all the people who have the skills and the experience and the acumen to actually teach young men and women what the right steps to take are, how to control their effort, how to control their emotions, how to focus on the right things, we're gone. And all you're left with is a role model-less society. So it should be no shock if you give a 10-year-old no role models and no real roadmap to being successful, that they turn out not to be successful. So that's kind of my general thoughts on that.
Yeah, no, it's great insight, and I really appreciate it. And I thank you for sharing all that stuff, because I know that's not always the easiest thing to talk about. I've got a really good friend of mine that grew up, I would say, lower middle class, but had a family and all that stuff. And he and I talk about this all the time, because he's adamant now that you don't really need college, and that you can do these different things. But he's actually done what he went to Ohio State, played golf, didn't graduate for different reasons, but a smart guy, obviously, and has done pretty well for himself. But one thing that I think that the reason that he got as far as he has without that education, and I would bet the same thing was for you, and I'm really curious, you had good coaches in your sports. You had coaches that taught you, that cared about you, that gave you like the track, the right and the wrong, the no excuses that you just mentioned. That sounds like coach talk to me. And I contend coaches in a lot of cases do more than teachers when it comes to setting kids up for success.
You, sir, are 100% spot on. So, in terms of the people who've been most influential in my life, I would start by saying probably Mrs. Beckett Delmar Harvard, such a powerful force in terms of my academics. But all of the next people on the list are all coaches. You're absolutely right, because that's the one place where, again, going back to our previous discussion, excuses don't matter. There's a right way and a wrong way to do things on the field. There's a right way and a wrong way to do things on the court, in the pool, on the golf course, wherever you are as an athlete. That's what coaches are there for. It's to give you constructive criticism so that you can be your very best, whether it be at the competition itself or become your very best as a person and ultimately an adult. So you're spot on. Those coaches there's been so many times where, I was sort of a late bloomer in football. I didn't, I was slated to start my junior year for the first time, but I actually had a pretty catastrophic knee injury heading into the season. So I didn't start a game until my senior year of high school, which is very rare for someone who winds up playing Division I college football. In fact, ironically, I was a 4-year starter in college. I started significantly more games in college at the Division I level than I did in high school, which is very unique. And so that being a late bloomer, there was a lot of times where, I just didn't feel like football was for me. And mind you, I'm a 4.0 nerd, right? Being forced to play football because I'm quote unquote big for nothing, as according to my older brothers and my cousins who were on the team. So, I quite frankly, it's not that I hated it, but I certainly wasn't good enough at it to love it for a long period of time. And those coaches really kept my focus, and they really challenged me to bring something out of me. So you're right. It does take coaches. It does take a village to raise good kids. And ultimately we all need to be making sure that we are contributing and we are giving back to the community around us.
Yeah, I could talk to you all day just about this. This is awesome. And we got to get to the financial stuff. I got 5 kids, and, as I look back, I think it's the opposite for us. I think we made it a little too easy for the kids, and they don't know how to struggle. I mean, they're fine. Don't get me wrong. They're all going to do really well, but I'm not sure I made them struggle enough. And I grew up a little differently. So my dad was pretty tough on me as a kid, and I didn't really want to do that with my kids. And I think retrospectively, somewhere in the middle would have been probably better.
So Terry, you're preaching to the choir, man. I don't know if you've had the great pleasure of reading my former colleague Neil Howe's book, Before Turning. This is how it works. these how the generational cycles work. You have the laissez-faire parents, and they turn out to be the tough parent. That their kids turn out to be the tough parents. The tough parents are the parents of the laissez-faire. It's a cycle. And these generational cycles matter, and they ultimately have a big impact, obviously, on the economy, on the political, social construct of the society. And so as much as you might want to be a little bit down on yourself there, I'll say you're probably doing a phenomenal job. Seems like you probably have 5 wonderful children and a wonderful family. So don't beat yourself up too much, man. You're just a victim of the Before Turning, like all of us.
Well, but by the way, I do own that book. There's 2 other books that I'm working on right now. So that's the 3rd one in line.
Absolutely. Must read, man.
Married or kids, Darius?
I'm engaged. I recently got engaged this fall to my beautiful fiance. We're excited to begin that journey, that chapter. But I assume kids will be in the near future.
Good for you. Well, that's exciting. Well, let's get to the fun stuff here, huh?
Yeah.
So I follow you on Real Vision. It's how I found out about you. And anytime you're on, I'm on it because I really appreciate your perspective. So I've got a list of things I want to get through. And let's start with Ray Dalio. He talks about the global debt crisis. And, I think I saw a statistic and I was shocked by this, but on a global basis, it looks like debt is 256% of GDP globally. Mm-hmm. Is that possible? And what do you think about that?
Yeah, I mean, in theory, you can lever it up infinitely. Now, obviously, the more leverage you take on, the more sensitive the economy becomes to interest rates and just general impulses and growth and inflation, because obviously you can have some catastrophic swings on debt service. But the reality is, now, look, Dalio's done a tremendous amount of work in terms of helping us all as investors understand the drivers of the debt cycle and, more importantly, how they unwind. I think how they unwind is what we're ultimately trying to assess when we do analysis of the credit cycle, both from a microeconomic standpoint but also from a macroeconomic standpoint. So I consider Dalio to be, sort of one of the forefathers of macro investing, and really the forefather of regime segmentation, which is the process a lot of us sort of Dalio disciples, if you will, use to sort of analyze the economy, use to sort of assess and ultimately quantify and handicap market risk through the lens of regime segmentation. So that's a big portion of our process here at 42 Macro, the firm I run, the macro risk management firm I run. So yeah, like Dalio's certainly laid it out for us. I think the two biggest takeaways as it relates to the debt cycle is, deleveragings can be ugly or they can be beautiful. And we've gotten so used to this beautiful deleveraging, if you will, that we've done in over the recent decade with, the expansion of the central bank balance sheet, and most recently the expansion of the public balance sheet, in order to sort of prevent broad-based deleveraging, a broad-based bursting of the debt bubble. But the reality is, the more you do that, those also have side effects as well, and they ultimately sort of squander and quash growth, the structural, the organic rate of growth in the economy. So it's not without costs, but certainly it's a political desire to effectively have a less violent deleveraging than the one that takes place that's a little bit more shallow, or a little bit more steep, that takes place over a shorter amount of time.
In the fact that we have elections, in some cases every 2 years, and then for the Senate and the president, obviously every 4 years, it makes austerity pretty difficult because nobody is going to be around long enough that they can ride it out. So nobody wants to be responsible for the front part of that, right? Which is getting everybody used to this idea that your life is going to suck compared to where it used to be just a few short months ago. And so we seem to be kicking the can down the road a little bit on this, and maybe we can get away with it. Ray Dalio says that we have the exorbitant privilege of the world's reserve currency. And there is some truth to that. I mean, it's completely true that that's the case right now. Do you think because of that we can gracefully exit the other side without a ton of carnage?
So I'll start by saying I don't think that there is an exit, right? I think a lot of investors use phrases like exit, in game, all that stuff, right? The reality is the world's going to keep going until it gets consumed by the sun or something, like, until the sun burns out.
We're not going to be around when that happens, hopefully.
Yeah, exactly. None of us will be around when that happens. So let's start there and work our way backwards. So Dalio is obviously, certainly not, you don't need me to confirm this, but I agree with Dalio's thought process on this. And, his thought process is very much shared by a lot of other investors as well, in terms of the exorbitant privilege, and that allows us to effectively run structural twin deficits. And that structural twin deficits come at a significantly lower cost of capital than it otherwise would come at. And so our biggest fear as sort of a economic superpower, if you will, is when does that exorbitant privilege end? I happen to have I don't know if it's a contrarian view. It feels contrarian relative to the smart guys in the room. It's probably not contrarian relative to the average person, the average Joe who has no idea what we're talking about. But I have a view that the country with the biggest guns controls the exorbitant privilege. There's no secret why the U.S. In the Bretton Woods system decided that the U.S. dollar would be the dollar that global trade is settled in. That global energy, petroleum products would be distributed and settled in. And it was for a reason. It's because it's beneficial. It allows us to live well in excess of our means at a much cheaper rate of financing than we otherwise would ultimately experience by traditional market forces. So I don't think the Americans are going to want to give that up. I don't think they're going to go quietly into the night. And so to me, it seems like we're on a collision course with countries like China and Russia that are looking at alternate means of settling trade and settling and trading commodities and settling, global capital markets. It just seems like we're going to be on a collision course. And what I mean by a collision course is not your traditional kinetic hot war, who biggest guns win, biggest tanks win. I think those are sort of distractions that prevent, sort of the public from really understanding what's really going on. Is we're probably heading towards a rift in this, in the societies, where there'll be an Eastern society on the China coin, the central bank digital currency of China. There'll be a Western society on U.S. dollar coin or NATO coin or whatever the coin it'll be. And ultimately, the smaller countries in different regions will have to choose, most likely, by their geographic locations, but more importantly, probably by their, religious and political affiliations.
You bring up interesting points on that. So, obviously with Bretton Woods, we had the Navy, right? So it was easy for us to say, we'll take over, we'll police the trade lanes. And, I don't know that they really ever envisioned that it would evolve like it has now, right? I mean,
Yeah, of course.
this is a long time ago from the 1940s.
Totally, totally. Yeah,
So,
no, I don't think they did either.
but you know, listen, opportunists recognize opportunity, and so over time, it's become clear how we got here. One thing that I'm curious about, I just think there's, you know, the Fed is so completely misunderstood, and you got people out there, these a-holes that are running gold scams, and they got the people thinking that the Fed is this nefarious entity. And you know, not to say that there aren't some things that, you know, there's like enough truth in some of these to get, you know, it's like the QAnon theory, right? There was enough truth in all of that that the average person couldn't tell the difference, and they didn't figure it out until after the election that was all bullshit, right? Or a lot of it was anyway. And some of this comes down to people just don't know how to research. They don't know where to go. They're too lazy. It's the TLDR society that we live in right now. And so on the topic of the Fed, right? I one of the things I wonder, and I think you'll be able to share some insight on this, you know, how political is the Fed? I mean, obviously, you know, Jay Powell's previous boss was constantly beating up on Twitter, right? But I get the suspicion, and maybe I'm wrong, but he's getting it worse now. It's just behind the scenes because they're not going to do it on Twitter. But I look at what's going on with the Fed and this hawkish stance. A lot of people like to paint the Fed as they're not that bright. And I don't believe that at all. I think they're super smart. And I don't think they're behind the curve in a sense that they don't see or sense that the economy could easily be rolling over. I think they're under a lot of pressure to kind of publicly fight inflation because the Republicans are killing the Democrats right now on inflation. And so they've been kind of forced to address this now. Well, they have a little wiggle room before later on when it's too late. Is that a possibility? Is that even true?
I think it's the modal outcome. I think it's more, I mean, obviously we don't know the truth, right? We're not in these rooms and in these meetings. But if you're told me what the highest probability outcome is, I think it's exactly what you just discussed. I mean, so let's start by saying the Federal Reserve is a government institution, right? Like it's a bureaucratic, very large institution with a lot of branches and a lot of people who have bosses and a lot of people with bosses who have bosses. That is, you see where I'm going with this, right? Like it just,
yeah, but the one thing,
hard
Gary,
for an institution
I don't
that big
understand.
to be.
I'm sorry, let me just ask this real quick, because this is the part that I don't understand, is that they don't seem to truly be held accountable by anybody, because after the president picks the chair of the Fed, that's it. I mean, yeah, they have to go and testify in front of Congress, but who cares? That's meaningless anyway. Congress has no sway really over those guys. So once they're in that position, they can do whatever the heck they want. Do I have that right, or do I not have that right?
Sort of. I would interject and say, or I would say it another way, which is they are unaccountable to an elected body and accountable to the population directly, and technically even unaccountable to different branches of government, the more noisy branches of government. But the reality is they're held hostage by the markets, right? Like the stock market going down 20, 30% is a big problem for the Fed, right? If they're deemed to not be doing enough to stop that, or more importantly, if they're deemed to be making matters worse. And so ultimately, the sort of ire of market participants is really the big avenue by which the Fed is held accountable. Again, these are real people in real jobs that have real functions in society. I mean, you think about the New York Fed in particular and its job with all the open market operations the Fed does, and all the sort of, different programs and schemes that help the Fed sort of control the quantity and price of money. If those guys are just asleep at the wheel, not doing their jobs, their colleagues on their former colleagues on Wall Street or their future colleagues on Wall Street are going to be picking up the phone and heading into the office and saying, "Hey, look, what the hell?" Right? And so you can imagine that's the case in the Kansas City Fed, where the bank of the regional bank head at some Kansas City bank and says, "Hey, Esther George, what the hell's going on here?" Right? So these are real people with real relationships in our very real society. And so the fact that they're not technically accountable, to the president or the Supreme Court or something like that, I think is almost irrelevant.
So I've read that the perception is that actually it's not the Fed that controls the politicians, but really right now the politicians are, and let me say this a different way, the money printing isn't really controlled by the Fed now. It's more controlled by politicians. Would you agree with that statement?
Well, yeah. So the Fed has never truly really printed money, right?
Right.
The Fed expands bank reserves. Well, bank reserves are a form of money for banks, but they're not a form of money for people in our economy, for consumers and businesses. Consumers and businesses need, bank deposits, banknotes, things of that nature to actually transact. And so, in terms of printing money, the way I guess your average Joe on the street would think about printing money, kind of helicopter style money, you actually do need the fiscal authority to go out there and actually create more money through the guise of treasury securities. They sort of, they increase their budget deficit, and then ultimately, sort of borrow more money from either the private sector or really in recent years, it's really been borrowing from the Fed indirectly through the Fed's various quantitative easing programs, which it does through commercial banks. And so, the reality is, the reason we're having inflation, this inflationary episode here over the past year or so, is a direct function of the fiscal authority after really 10 years of being in retrenchment, really waking up and not only waking up, but delivering kind of back to back to back, three of the most powerful fiscal programs in U.S. history.
Hmm. Well, that's interesting, and I'm glad you brought that up because I've followed you, and I think I have a decent handle on your perspective. I know that you thought initially, and maybe that's changed a little bit, that we might have been able to skate through the first quarter with a little bit of a bump, but then, a bump up, meaning, but then later is where, we'll say shit gets real, right?
Yeah.
As far as some of the downside. Now, having said that, one of the things that I just don't think I'm hearing enough about, and I'm not a macro expert like you are, so I play macro on TV, but not in real life. And I look at this, and here's the way I see the world. And maybe it's just because anecdotes to me are easier to understand. I didn't have the college background that you did, so I'm not sure that I could even understand some of that stuff. But here's the way I see it: we pumped, I don't know how many trillions of dollars into the economy through unprecedented fiscal stimulus. We took $40,000, put it in the hands of college kids who chose not to go to work, but they'd rather smoke weed, play video games, and buy GameStop or buy crypto or things like that, right? On top of that, we gave paycheck protection plan checks to businesses that really didn't need them. In a lot of cases, some did, and I, by the way, I fully supported the concept. But as you know, a lot of people like I know that got $200,000, $500,000, $1 million, and by the letter of the law, they qualified for the program. So they didn't do anything illegal or wrong, but they didn't need the money, right? And that money got dumped right back into the economy. And so as I look at 2022, the first thing I know is that all that stimulus is gone. And I'm talking about the fiscal side, right? I see that oil prices are pushing $5, gas is going to be $5 a gallon and probably higher pretty soon. I follow Paul Hodges and, his concept on the petrochemicals and how that peaked. And so the buying and selling of the petrochemicals is curbed, which is every form of production that's out there. I just see it really difficult. And then on top of that, if you look at all and I think 2021, if I understood the math correctly, was the single biggest year of equity inflows in the last decade. Okay.
Not only single biggest, it's bigger than the last 20 combined.
There you go. So it's like, how on earth does anybody expect the market to push higher this year in the face of all that? And maybe I'm wrong, and I sure as heck would like to know how, but it's hard not to take, for me, based on that anecdotal stuff, at least a quasi bearish position.
Yeah, well, let's start by the backdrop, right? So 2019, I want to say the market was up like 30%. Don't quote me on these numbers. I'm pulling them off the top of my head. 2020, the market was up like 20-ish percent. And then last year, the market was up 28%. So like the market's gone up a lot in the last 3 years. And so to take a quasi bearish position in the context of the growth cycle very clearly being past peak, the inflation cycle rolling to its peak, and the monetary policy tightening cycle and fiscal policy tightening cycle really just getting going, I think is a very prudent thing to take. I mean, look, we're just, valuations are very stretched. We've covered a lot of ground, covered a lot of distance, and quite frankly, the fundamental narratives, the core tenets of why we've covered so much ground, i.e., record growth acceleration, record nominal GDP expansion, fiscal stimulus, monetary stimulus, the vaccines, massive, innovation on the medical front. Let's not even talk about what mRNA is going to do for, cancer treatment and all this stuff, right, over the next few years. We've covered a lot of ground on a very fundamental basis. The problem is a lot of that, if you think about it as a stool or a chair or a table, we're just slowly taking away those legs. Mm-hmm. And hopefully, if you're a bull, the economy is left in a sort of a self-sustaining manner where it can float and levitate. But the reality is it's probably not going to float and levitate, right? It's unlikely that we can sustain this level of demand. We can sustain sort of, this level of price appreciation. We can sustain these valuations when you take away all those legs. And so I think, kind of to summarize our views on the market, I think it's very reasonable the market could be down at 20 to 30% off its highs this year. And I don't say that to scare people or make headlines because, I've been doing this institutionally for a long time. That's usually not how you get institutional client meetings. But the reality is, everything I look at in our research suggests, like there are different indicators that we look at. If you think about household equity ownership as a percentage of their net worth, or household fixed income ownership as a percentage of their worth, is kind of two sides of the same coin. You look at where we are in the consumer confidence cycle, you look at where we are in the labor cycle, you look at where we are in the policy tightening cycle. All those different levers tell you that it'd be very normal for the stock market to be down 20 to 30%, mm-hmm. right? Like we were down 20% in Q4 18, making a very similar call as we are now, but all the factors, all the dynamics, all the tenets associated with the bear call are significantly worse now in terms of where they are. And it's very unlikely that we get bailed out by the Fed, at least not for a few quarters, because we will have no reason from a labor market perspective or from the perspective of reported inflation for them to sort of back off. There's no off ramp, if you will.
Yeah, that's interesting. I listen to Paul talk about this, and they think the Fed, he thinks, at least I think he thinks, based on what I've read and heard, that, the Fed's likely to come back in at some point. It's an election year, and I got to believe there's going to be pressure to stabilize things. And if you go back to, was it 18 or 19? I think it was 18 when the markets kind of pushed down and then forced the Fed's hand, or I don't know, forced the Fed's hand's the right way to say it, but I think the Fed got the message and kind of backed off the tightening. And I wonder if, the Fed will be forced into action. I mean, look, as I understand it, the equity markets have essentially become the collateral for a lot of borrowing that takes place. And so if the collateral falls by 20 or 30%, it creates a series of other bigger problems. And so they'd rather have an ongoing asset bubble than have to deal with, the collapsing of the collateral and the margin calls and things like that. Where am I wrong in that thinking?
I wouldn't say you're wrong, because I think it's just a variant viewpoint, and that's what makes a market. But I will say where we disagree with that view, that sort of central tension. Well, sorry, we don't disagree. Sorry, let me take this step backwards. We do not disagree with the view that the Fed is going to panic and blink at some point and will not be able to enact the number of rate hikes that are currently priced to the market, will not be able to shrink its balance sheet according to, kind of what's projected, what's heard out there around Wall Street, which is around $1 trillion of shrinkage over the next year, or from the year ensuing when they start the quantitative tightening program. I don't think they have a hope in hell in completing either of those objectives. But the reality is they're going to have to try. And when you look at our analysis of inflation dynamics in the country, whether it be through wages, whether it be through tradable goods, or whether it be through, it's just more sticky to pockets of core PC like shelter, it's very unlikely that inflation, it retreats to a level, over the kind of the next couple of quarters that will give the Fed an off ramp from the perspective of its policy. Moreover, it's very unlikely that the labor market falters over the next couple of quarters that will give the Fed an off ramp from its policies. We still have, about 120 basis points in terms of the labor force participation that we could potentially make up over the next year or so. So what does that leave you with? The only thing, if the Fed's got a dual mandate, I would argue they have a triple mandate. There's the maximum inclusive employment. There's the average inflation targeting, and then there's this financial stability mandate, right? That's the one that we sort of as investors have been really conditioned to overweight in the most recent decade, in the post-crisis era. The reality is, if the one we're choosing to overweight becomes the only one that's left that can send feedback to the Fed that they're on the wrong course, guess what? That means financial conditions have to tighten, right? Because again, the Fed is not going to get any signals from inflation or the labor market over the next 2-3 quarters for them to back off. And so it has to come from the stock market. It has to come from credit spreads. It has to come from volatility. And so the bull case can't be the Fed's going to blink, because the only thing, according to our analysis of the labor market and inflation, the only thing that could get the Fed to blink over the next 3 quarters is financial conditions tightening. So that can't be the bull case for
well, guys. I mean, not right away, but I mean that could be the ultimate buy the dip, right?
It always is. And look, we would expect to be buying that dip. I just think the dip's going to be a lot lower than we're conditioned to, certainly in the last 18 months. But really, realistically, it's probably a lot lower than we're conditioned to in this sort of post-crisis era. I mean, again, the Fed can't look at a stock market that's down 30% and see core PCE at 5% and see a labor market that's, got an unemployment rate with a 4 handle and look at us in a straight face and say, I got to go bail out the stock market. It's not that they can't, it's that they won't, according to all the 4 guidance they've given us. And so I'm not smart enough. I'm not smart enough to call them on their bluff.
Well, I'm not sure. Yeah, I don't know either. I look at that. And I guess it makes me wonder, like they can, well, I don't know. We'll see. I guess I hope we don't get to that place, but I do think we could easily get to 20 or 30%. And that's why, I think what you do is so valuable, Darius. And even though I'm yet, although I will be, I think, a subscriber to your service because I love what you do. I think this is a year for the first time in a long time where risk management really matters. It didn't matter before, but the BTFD, I think that's different now, right? Than what it was. And so this is the first time where maybe you don't buy the dip, but you sell the rip, right? Isn't that closer to where we're at now?
Yeah, we've been in sell the rip mode for the past few weeks now. We used the bounce off the January OPEX lows to raise a considerable amount of cash. I want to say we took our cash position from around 4% to around 28%. In that bounce, we made some sales on Wednesday, the 2nd of February, if I'm not mistaken. So we're very much in sell the rip mode. We're not in a rush to get out because we in terms of our sort of market risk indicators, our trigger oriented indicators, they're not yet saying that this is the time is here to rush for the exits. But they're all close to triggering, of course. And I think I suspect they will trigger sometime in the springtime. Right now, I think the next big macro catalyst isn't necessarily bearish. In fact, it's probably quite positive. If you think about the bounce in high frequency data we're likely to get in the month of February and the month of March as a function of the slowdown we saw in December and January from Omicron. That was it's starting to look at, if you look at the PMIs, you look at the leading indicators like consumer confidence, business confidence, Omicron did have impact. Now, it wasn't in GDP terms, it wasn't this like big nasty bite like Delta was, but it was a more pervasive kind of like, man, this thing is just really slowing and more importantly, slowing off of a big number in Q4. And so, you could see GDP statistics in Q1 really, kind of get punched in the mouth by that. In fact, I want to say the Atlanta Fed is somewhere around 0 to 1%. And that number should bounce in Q2. But a lot of the positive delta, the impulse, will actually take place in February and March. And so, you're likely to get the market at the bare minimum hanging in as a function of that, because you're going to keep the sort of bottom up micro oriented investor, the guy who only looks at company fundamentals and ignores macro. They're going to be in there listening to companies saying things are not only stable, but getting better at the margins, right? And those people will be inclined to buy the dip and not sell the rip. But eventually, we're going to get into the springtime where we get back towards our trend of deceleration. We're going to be a lot closer to, we'll be probably already into rate hikes and a lot closer to, or actually already commencing with QT. And then from that point forward, there's probably no good news for several quarters.
Yeah,
and
I
rate
mean,
of
I think
change terms.
that makes perfect sense to me.
Mhm.
You look at, so, and the other thing with Omicron that, it's different than Delta. I mean, a lot of places, I live in Michigan, we shut back down for Delta. We didn't do that for Omicron. Yeah, people
That's
had
what
to
I
wear
mean.
masks, but restaurants weren't closed, shops weren't closed. We didn't,
Mhm.
we didn't have that. Now people chose to kind of opt out, right? So
Yeah.
maybe the volumes were down a little bit, but they weren't
Mhm.
forced closed like a lot of places were for Delta. So I
Mhm.
think Omicron in that sense wasn't quite as bad.
Yeah, it was just more pervasive, right? Like, so
Yeah,
like, um, for example, like you didn't have a factory get forced closed by the government. But what you did have was every factory basically having to have a bunch of people call out sick,
yep.
right? And so like, production slowed in that regard, services consumption slowed in that regard, but it wasn't necessarily mandated by the government in a way that would just really take a real big bite at and punch out of GDP. So, probably the net results probably somewhere around the same in terms of its ultimate drag on the economy, which means the positive about the recovery from that back towards the trend should be kind of similarly sized. But the reality is, once you get past that, I mean, there's really nothing to look forward to from a growth perspective. There's nothing to look forward to from an inflation perspective. If you're a type of company that relies on rising inflation, realize or expectations to make money, and then there's obviously nothing to look forward to but negativity for the perspective of the monetary and fiscal impulses.
Yeah. So I mean, as I kind of take a look, so do you think, I'm watching like, I didn't look today, but the Nasdaq was very recently still below its 200-day moving average. I think the S&P is above it. So do you think that it's possible where the broad index averages could kind of get back in close to the highs before they dip back down? Or do you think this is going to be a lower high relative to where we were at the end of the year? And then it's just kind of where you can trade it, right? You can take advantage of these swings, but the general direction is not going to be any higher than where we started. And obviously, based on what you've said so far, you expect it to be lower at the end of the year.
Yeah, no, that's a great question. So if we did see an index get back towards its high, it'll be this S&P because there's a
Mhm.
lot of stuff in the S&P. The S&P is a broad enough diversified index that it can benefit from rotation in a way that the Nasdaq can't, or the Russell 2000 can't, or other indices like the Dow cannot. So if we do make new highs, it'll probably concentrate it to the S&P. I don't think the Nasdaq has a hope in hell of making a new high. Certainly not the Russell. But the reality is, based on our analysis of the derivative space, we do a tremendous amount of work on there in terms of identifying extremes and consensus positioning in the options and futures markets, and really through the lens of volatility and covariance. But the reality is, there's just not a lot of fuel to sustain a bounce big enough for that. Typically what you have after these sort of big corrections, like what we saw in January, is there's a lot of sort of I'm kind of going second or derivative Greeks here, but there's a lot of sort of volatility in the system that allows for, what I call like a Vanna chase, where, the decline in implied volatility is really perpetuating new highs in the market, where you have dealers who are formerly short of gamma really scrambling to perpetuate that upside. That's exactly what we saw after Q4 18. That's exactly what we saw after March of 2020. That's really, to be honest, that's exactly what we saw in August 15, 16, in August 15 crash as well with the China deval. So we just don't have that setup anymore. Like, it's, for whatever reason, the structural bearish fundamentals that I've been talking about, that other macro investors will probably have on the radar as well, they seem to be overwhelming, kind of what a natural response would have been to January's correction in the derivative space, which makes it less likely we can burst to new highs on a post-Omicron bounce dynamic. So to answer your question, I wouldn't be betting on it. I wouldn't be surprised by it in the S&P, but we're certainly not betting on it. As I mentioned, we saw, I don't know where the S&P was on February 2nd when we made those sales, but it was probably about a 50% retracement from the decline, and I don't believe we've gotten higher than that since then.
No, I mean, the markets, I didn't see where it finished today, but they were up the last time I looked. So
Yeah.
I appreciate your perspective on that. And, our view is, so as a financial advisor, I don't deal at the institutional level. I deal with families, and, most of my clients are retired or pretty close to retirement. And so from our standpoint, we kind of split it up. We use an outside firm that has an algorithm, Howard Capital, based in Atlanta. They've got a great trend following system that works really well. And then we have other strategies that we use that I'm really kind of, I've basically kind of taken risk off the table across the board, not entirely, right? But across the board, we've de-risked because we've done really well for the last few years. And now we're just trying to kind of, I've learned over the years that it's, first of all, the efficient market hypothesis is bullshit. I don't believe it. And secondly, I think that the market, definitely can be timed by the right people, and people have proven to be able to do it, like Ray Dalio, obviously, and others. But the smartest guys and the ones that have done the best are the ones that know when to take their chips off the table. It's not the other way around. I mean, sure, they do well when the market's going up, but they're not the ones standing, without the chair at the end. And that's kind of where my head's at right now for our clients.
Yeah. And look, I'm going to borrow sort of a Greenspan at this famous quote in the 90s about inflation. Like, you need a model to like predict inflation, and you need a model to understand, like, when you're in a deflationary regime. And then he made the joke, like, you need a model to determine which model to use. Right. And I think as investors, we kind of, it's very similar, right? You need a model to understand when it's time to go risk on or risk off. You need a model to understand, like, when it's time to just, not just go risk on or risk off, but actually just get the heck out of the room, or, get back to shore. And ultimately, the punchline of the joke will be, you need to know when, which model to use. And quite frankly, I think we're going from the since June, markets have been operating in this sort of risk on, risk off dynamic. The sort of frequency of what we call grid regime, these market regime dynamics where, leadership is either offensive or defensive in the equity and credit markets, or the rates are either going up or going down. The frequency of those market regime transitions has increased dramatically since June. And typically you have a couple, material transitions a year, right? And they typically are aligned with the, inflection points in the growth and inflation cycle. Since June, I mean, it's been like a hodgepodge of nonsense, and it's been kind of really difficult to make money to the extent you have a trend following strategy, because there's been really no trending, outside of crude oil and energy. There's not, and stock and tech stocks going down. There's not been a lot of trends to take advantage of. So like the reality is, it's been tough. And I think the reality is, I think that is a signal. It's telling you that, it's becoming harder and harder to make money betting on versus risk off. And eventually the key takeaway for a lot of investors is going to be, let me just get the heck out of here. This is too hard. And I would bet, I'm sure you have all these conversations with your clients. And I bet to a person, they're like, I don't feel, what's the point, right? I think what's the point is probably the general takeaway. Why am I fully invested here? We just had a bunch of great years. Like there's all these storm clouds on the horizon that are pretty readily available. What's the upside, right? Like I can get you to a bull case. The bull case has kind of got three tenets, right? Consumer, or a lot of the AI bulls survey, that style of investors are already pretty bearish. They're quite actually at a bearish extreme, and that tends to be positive for the market over the medium term. Supply chain disruptions are easing. So whatever you think about corporate earnings and micro fundamentals this year could actually improve as we get throughout the year. And then obviously there's the bull case of what I would consider to be low probability bull case, but it is still potentiality, which is more fiscal stimulus, most likely through the lens of the expanded child care tax credit, things like that. So that if the bull case does have legs and it's legitimate, it's reasonable, it's just, in my opinion, far less probable and far less sizable than the bear case. Mm-hmm. And the bear case, in my opinion, is a lot more powerful when you think about the main driver of markets, which is liquidity from the fiscal and monetary authorities, and those are both going in the wrong direction.
So on that note, it's interesting because we've heard this narrative for a while. And by the way, I'm not anti-crypto. I actually think crypto is, potentially has a bright future, but I think there's a lot to get sorted out there. So many people bought into this, Bitcoin as the narrative that it's, as the Fed printing goes, the money printer goes burr, all this stuff, that the Bitcoin would act differently. And so far, it's only acted like a risk asset. In fact, if you've watched it lately, it's been sort of leading the equity markets. Like Bitcoin seems to me to be a day to maybe two ahead of what the equity markets are doing, which is interesting, but it's still trading like a risk asset. And I look at last year for all the reasons that we just described with that fiscal pump that we had. I have a hard time seeing where the super bullish case for crypto this year takes hold either. Am I getting that wrong, do you think?
No, I mean, look, I think it is certainly a risk asset. If you look at one thing we do at 42 Macro to help our customers and clients understand kind of the expected return distribution of assets, the kind of expected volatility distribution, expected covariance. We've backtested everything through the lens of what we call our grid regime framework, which is, sort of how we sequence the economic cycle through impulses and growth and inflation. And so the reality is the volatility and covariance of Bitcoin looks very similar to the volatility and covariance of a high beta stock. In terms of its covariance with other risk assets in general, S&P 500 credit spreads, all that stuff. In a cross regime. So the back test, like if I put the back test to the S&P 500 high beta stock index next to the back test for Bitcoin, the numbers will just be bigger for Bitcoin, but the characteristics of the back test would be very similar. So this is something we understood, I think, as well as anyone when we made the call to get out of crypto and going back to the fall, saved our investors or saved our customers a lot of pain trying to buy the dip in crypto for the past few months, because look, it's just not in the right regime from a fundamental standpoint. It's not in the right regime from a market risk standpoint. That said, could crypto have a bounce into the spring? I think there's some positive fundamental dynamics, like with Ethereum 2. There's obviously the halving cycle in Bitcoin. Sure, that would certainly be in accordance with a positive resolution in market terms to this post-Omicron bounce dynamic, where the growth impulse is positive as a transitory positive impulse, and that transitory positive impulse tends to lift risk appetite, lifting nominal wages for sure, and people's ability to speculate in things like crypto. But the reality is, why would you, if you've had a good year last year, had a good few years, to the extent you were invested at all in U.S. equity and capital markets, why in the hell would you, after everything we've just seen as a preview of what could happen in 2022, be licking your lips and kind of chomping at the bit?
Yeah, one last thing I want to hit you with, and I know you got to go, so I appreciate all the time you spent with me.
Yeah, no worries.
On the crypto front, so one of the things that I find really fascinating, and I know you're following this story because everybody is, right? But the Canadian truck drivers and the GoFundMe deal, how they took the money and weren't going to give it back, then they got pressured into giving it back. But one of the interesting things in the use cases for crypto is that people sent Bitcoin to these people and it was there in seconds and nobody could get in the way of that, right? Yeah. And I look at, are you familiar with the book, and have you read the book Woke Inc. by Vivek Ramaswamy? Ramaswamy or Ramaswamy? I forget which one. I think it's Ramaswamy.
No, give me the sort of.
Let me tell you, it's Darius. It's a phenomenal book. So his story is Harvard grad, got a job as working for a hedge fund. And I think a few hedge funds, worked in the hedge fund business for 7 years in the biotech pharma sector. Then from there, started his own biotech company and did really, really well. Okay. And he kind of ran into, I'll just give you this part of it. He kind of ran into an issue with his employees, because around the time of all the George Floyd stuff and the riots and all this, and his employees really wanted him to come out and make a statement and, do the right thing. And he didn't buy into some of the narrative and all that stuff. And so he found himself in a really difficult spot, because as a CEO, he definitely wanted to be empathetic and support his employees, but he also didn't want to be not true to who he was and what his beliefs were. And so he ended up kind of coming up with a strategy that kind of made everybody happy. And it wasn't so much about the things that they were pushing him for. It was really just about socioeconomic status and the things that they did to help those people. Okay. But he stepped aside, and so the reason that this all is important is because in his book, he goes into great detail how the original Occupy Wall Street movement was hijacked by the woke movement, and the big companies like Goldman Sachs and Unilever, and it's not exclusive to one industry, don't give a shit about the cause. They're just in it because they've leveraged it and have been able to make a lot of money, and more importantly, change the narrative and take the focus away from capitalism and go to this new stakeholder capitalism stuff, right? And so in the end, why this becomes so important is because I'll fast forward to where I'm at in the book, and I haven't finished it yet. I'm about 3/4 of the way through. But here he is having a conversation with a fellow tech billionaire. Okay, this guy's a billionaire, not 100 millionaire.
Yeah.
And they're talking about where this is going, and they're both scared shitless. And the tech billionaire said, please do not mention my name in any of this for the repercussions. But he said, I can see a place where Verizon listens to your phone calls and cuts you off because they don't like your ideology. I mean, Twitter has already gone into people's messages and bounced them off the platform, not for what they do publicly, but what their messages are, right? And we know that they deplatformed the president of the United States. And I'm not saying, you know, I'm not getting into the right wing, left wing, any of that stuff. What we've created is a monster. And what they basically said is that there's only like 50 on-ramps through technology, and they're all controlled by big tech. And so there is no out here at this point. They control everything. And you know, so I go back to Bitcoin and I'm like, Bitcoin's the answer for that, at least. It's, and if it's not Bitcoin, because I'm not promoting Bitcoin or saying anybody should buy it. I'm just saying Bitcoin as a form of a decentralized currency at least stops that from happening to some degree. Does that make any sense to you?
Ooh, that's a loaded question. So does Bitcoin stop that happening to some degree?
Well, it's a way to at least circumvent those issues, potentially.
Yeah, but the real power of big tech, in my opinion, is the you know, the sort of the avenues with which we communicate to each other, as social media, obviously, being the primary kind of avenue, and then the sort of storage and manipulation of data, of user data, of all the data that we generate as people online, right? Like, and so it's unclear to me that Bitcoin specifically can address those two particular the threats to those two particular things.
Yeah,
but, you know,
it won't. I mean, it's not.
Yeah.
I can't do that. I don't think that's not what it's for.
Yeah. But there, I think there are solutions in the cryptocurrency ecosystem, in the digital asset ecosystem, that may be able to address that to the extent that they get widely adopted and widely capitalized. But I'll take a step back, because you said something that really resonated with me in terms of, like, you know, hey, these big companies, they really control all the sort of avenues, the on ramps into you know, sort of this digital ecosystem. And the reality is that's been true for every moment of American society, right? I mean, there was always big players that sort of controlled this, going back to the monarchies in England, and the people who came over as, you know, aristocrats, and people who came over as slaveholders, and people who owned factories in the Industrial Revolution, and, you know, people who owned, you know, sort of, I don't know, what would it be? People who owned the internet back in the 90s. You know, there's always been established legacy players whose interests are being, you know, protected, right? And don't want to have the apple cart upset, you know, by revolutions in society. Problem with that view, and the problem with anybody fighting change, is that you're on the wrong side of economic history. And this goes back to the book we talked about at the beginning of the program, The Fourth Turning. You know, every 80 to 100 years, we have this kind of revolution where the established, you know, players in society who benefited the most from the legacy rules of engagement, you know, sort of the, you know, the legacy capital in the world, the legacy stakeholders, are all going to get upset by the people who've grown up in a system that doesn't work for them. And it always happens when those people take control of political office, with different views, different thoughts about how the world works and how the world should work, that are different than the legacy players. So this is no different than whoever the current winners were 80 years ago, you know, kind of coming up and saying, hey, look, you know, what would have been horse and buggy whip guy, like, get out of here. We have this revolutionary way of getting around. It's called the automobile, or, you know, like, or going back to internet. It's like, get out of here, snail mail, or I don't know what telegram, or, you know, I'm joking. But,
smoke signals.
You know, no, we have this revolutionary new way of communicating. It's called email and HTTPS and all that stuff. So like, this is just, it's part of change, right? Like, and I'm sure by the time I have a head full of gray hair or no hair at all, that I'll be pissed off about, you know, kind of the social agenda. But the reality is, it's just how life works. We have to get over it and accept it for what it is.
The only difference, though, Darius, I think right now is that they have the unprecedented power and control to manage the narrative, right? And to actually shape the way that people think. I mean, there's no doubt.
You think it's unprecedented? I would argue the sort of the limited distribution of information in the sort of newspaper age was significantly more powerful than anything that's happening today. I mean, you go back and, you know, let's use sort of like, you know, the early, you know, Civil War times, right? Like there was like one newspaper for the South and one newspaper for the North, right? And like that's what you thought of the war. And the war in the South was obviously a very different war being fought than the war in the North in terms of the social ideals and what the ultimate goals were. So I would argue the concentration of information and the sort of the ability for other, you know, sort of non-consensus parties to take over and really promote their ideals and their beliefs was worse back then than it is now. I mean, Darius Dale can, you know, I can tell anybody who's willing to listen in New Zealand, you know, what I think about the markets and the economy, you know, but I couldn't do that 20, 30 years ago. Right now, the problem is there's a lot more pollution, there's a lot more noise, but ultimately there's a lot more avenues for, you know, people to express themselves. And I think what we're really learning is that, you know, I think what a lot of established players are learning is that America is not as homogenous as it once was thought. There's a lot of people here with a lot of different views.
Yeah. Well, and I, you know, you're 100% right on that. And I guess time will tell on this. The other, you know, the other thing that's a little bit scary, and it's one of the, yeah, I don't know if you know this, you know who Chamath is, right?
Oh yeah, of course, that guy. Right. Yeah. He's a good storyteller.
Well, he is. And so this is great. But one of the things that Vivek talks about in his book is that Chamath, and I'm laughing about this, and I'm not sure it's even something we should be laughing about, but he actually floated the idea of Facebook creating its own army/militia. Like in the view that they are their own state, and they're, you know, that's where I think, and that's the concern that Vivek has in his book to some degree, is that there seems to be this idea that eventually these DAOs and these borderless things in the metaverse actually becomes the state, and it sucks the resources in a lot of ways from the existing state. And, you know, it's a transition at that point. And it's fascinating. I don't know how, you know, how possible that even is, but it's an interesting perspective.
No, I completely agree with the perspective. I tweeted this on Saturday. There is no reality, only perception. Like we no longer live in a world where what is news is news. Everything is now our interpretation of what happened. Like there's this raw kindling, like, you know, I'm in Miami now. And so there was some shooting at Publix, you know, down in Coral Gables, and it's obviously really tragic. But the reality is that kindling, that guy shooting the guy is what happened. But by the time I consume the information, it's, you know, gang violence, it's mental health issues, it's two guys got into a fight. There is no more like raw news anymore. And we have to accept that as a function of, one, of social media, but two, as a function of, you know, capitalist enterprises who make money off of this type of construct, right? Like, you know, we can't say we want a capitalist society and shit on, you know, the younger generation for their anti-capitalist ideals, but then also say we need to regulate, you know, big companies like Facebook and Twitter for not being capitalist, right? You know what I mean? Like, you know, for not for doing things that are in their own sort of best interest as it relates to making money. So I don't know. I think we're just in a weird, dangerous time if you're someone who is a legacy stakeholder. We're in a fourth turning. The nature of fourth turnings is legacy stakeholders get the boot.
Yep.
I mean, you replace with different stakeholders. So you can either fight it or you can accept it, but it's coming. We're here.
Well, when you, in the future, when you have your kids, you're such a level head and just a clear thinker. We need people like you that are out there shaping what actually happens. So I hope that you continue to have just immense financial success because I know you'll do the right thing. And I want people to have success and be wealthy, but I especially want people like you to have that, because if you've got a hand in shaping what the future looks like, then I think it's going to be a pretty bright future. And I appreciate
so very kind of you, man. God bless you for saying that, man. I knock on wood. We'll keep my head down and just keep grinding, and we'll see where I am in 20, 30 years.
Well, I'm going to follow closely, and I'm not waiting that long, by the way. So you and I are going to have another chat. Hopefully, in the not too distant future, we can come back and take a look at what we've talked about here and see how close we got it. And then we can talk more. By then I'll have read Fourth Turning and you'll have read the Woke Inc. book, and we can compare notes.
Absolutely. Yeah. Well, the next show will be titled Dale Says It's the Time to Buy.
I love it.
This one will be Dale Says It's the Time to Sell.
Well, we're going to take you up on that. And again, Darius, thanks so much for your generous contribution to the show and your time. And you were really interesting to talk to and a lot of fun. And I wish you the best of luck. And I'm excited to watch how things go from here.
Likewise, man. Best of luck with the program. I can already tell. I love your energy. I love your spirit. This is going to be a great listen. I'm adding it to my weekly list, man. So looking forward to it.
Appreciate that.